Welcome back to the channel. Today's video, we're going to be looking at financial literacy and education as a whole part of a series. This is a compilation of the entire week's work, so I hope you enjoy it. It is estimated that 66% of Americans are now living paycheck to paycheck, which is a major problem in America. Now, in today's video, we're going to be talking about living below your means and within your means, and how it is one of the most important, crucial steps to achieving financial independence. But what does it really mean to live below your means? Simply put, it is a conscious financial decision to align with your values and goals, long-term, short-term goals, rather than trying to keep up with the Joneses or indulging in unnecessary luxuries. So in today's video, we are going to break this down. Now, many of us struggle with money management. This is really where overspending comes in, lifestyle inflation, lifestyle creep, whatever you want to call it. It comes from this and itself. We tend to upgrade our lifestyle as the income increases. That is the problem. So when you get a raise at work, when you get a promotion, you might move to a bigger house. You might buy a little bit more luxurious items. You might upgrade your car rather than directing the extra cash towards the financial goals. That can include retirement. It could be saving for your children's education. There's a lot of goals that people do have. When it comes to financial goals, writing them down on paper does make a big difference. This leads to the never-ending debt cycle, the stress that comes with it, the financial anxiety that comes with it. There are so many negative things when it comes to being in debt overall. Now, we got really caught up in the idea of having the latest and greatest is what we need and will make us happy, rather than adding and really thinking of what truly adds value to your life. That is really the differentiator overall. Before we know it, right back to living paycheck to paycheck like a majority of people are doing. No saving, no investing, no 401k contributions. And of course, the vicious cycle starts. When you start accumulating personal debt, when you start looking at living paycheck to paycheck, when the debt gets to the point of not being able to cover the interest, now your credit score is impacted. Now you can have a lot of negative things just kind of snowball from having that paycheck to paycheck mentality because you are living outside of your means. But the truth is, we don't need stuff to be happy. For a lot of people, the retail therapy kicks in, but honestly, it is a fact. Research has shown once our basic needs are met, additional wealth doesn't actually lead to greater happiness. Kind of crazy to think about the studies, everything that's out there and the research, but think about that. Having additional things don't really equate to happiness, and having additional wealth doesn't lead to greater happiness. So why do we always prioritize having those material possessions, instant gratification, over creating financial security for ourselves and having that peace of mind? This is a great time because it's a good time. Take a step back, reassess your priorities and exactly what you want out of life. Start making conscious decisions that align with the values and goals that you set. When it comes to living below your means, one of the biggest obstacles to achieving that financial independence is mindset. This is where education comes in. This is where consuming content like this, reading books, reading psychology of money makes a big difference. Shifting our focus from consuming to investing, from short-term pleasure to long-term fulfillment, is the game changer. We need to recognize that financial freedom is not just about money, but more about living below our means, but being intentional with our spending. This is where a lot of the frugality comes in. If you've seen any of the videos, really creating a financial system that is going to really work for you, not against you. It seems like the education system in this country has done exactly that. It is really poised us. When you think of marketing, when you think of everything you see on social media, when you see commercials, even on the radio, on TV, everywhere you're inundated with buying this, buying that, and having this. So how can we flip the switch? What can we change the mindset? And how can you start living below your means? First, tracking the expenses, creating a budget. I say this every time. When you start the accountability piece of every single dollar that you have, you can quickly identify areas that you can cut back, where you can make adjustments, and where you can allocate money into different parts of your life, really departmentalizing them and seeing where you can go ahead living in really the debt-free journey and repaying that debt. Second step in this, prioritizing needs over wants. Now, this is something that was actually really stressed in second grade. My son just completed second grade. Prioritizing needs and wants, and what is the difference between them? Very, very basic, fundamental. Be very honest with yourself. Again, this is the accountability piece. Do you really need a new designer handbag? can you do with one that you already have? Do you need 5 pairs of shoes, 10 pairs of shoes, 50 pairs of shoes? If you're cutting out a lot of those unnecessary expenses, this is a really focus on building wealth rather than wasting money on things that actually don't add value to your life. Now, one of the most effective ways to cut back is looking at a 30-day rule or even a 7-day rule. This is a pretty cool way to do this. When you see an item you want to buy, wait 30 days before you make the purchase. If you still desire and if you truly need that item after 30 days, then go ahead and purchase it. And trust me, even like the buyer's remorse will be completely gone. You'll be surprised that if you wait that 30-day period on something you really want to buy, you do not end up buying it, or you actually forget about it after that 30-day period. Another strategy is 1 in, 1 out policy. This means that every time you bring an old item, every time that you bring a new item into your life, an old item has to go. This will maintain the balance level of your possessions, preventing cluttering from building up in your house, and really making a kind of a frugal, streamlined life. And of course, when you think of personal transformation here, that's exactly what I did. There were a couple years ago when frugality really started to kick in, when it was more about the experiences in life than it was about the possessions, when it's not about, so much keeping up with the Joneses, having the newest vehicle, but having the experiences in time is really at the point of my life where I'm at. It's not so much about the material possessions. It's about the time that you're never going to get back. And of course, when you think about this, looking and cutting back on some of my expenses, cutting back on unnecessary expenditures, investing in myself, looking at online courses, starting the YouTube channel as a second source of income. Within about 2 years, paid off all of our debt. The only thing we have at this point is a house, the emergency fund fully funded, even looking at the retirement plan fully funded, and just adding more and more on there, giving myself a very good sense of the financial freedom and the security, and it's incredible. You don't really have to worry about what is going on in the market. Don't even monitor it. I'm making regular contributions to that 3 ETF portfolio, doing incredibly well. Now you fast forward a couple more years when we're getting ready to retirement, we have a very strong, really well-built financial system that is going to provide passive income. A lot of people say, is passive income a joke? Is it something that really works? Absolutely. When you live below your means, and even now looking at putting 15, 20, even 25% of our income, because we live below our means, into an investment account, it really starts giving us the sense that financial independence is possible. And it's not just about money. When we get to the point of no longer having to work, we're going to be all set and know exactly where we're at month to month and even a year to year basis. So in conclusion, one of the most powerful tools is living within your means, making conscious financial decisions, prioritizing those needs over the wants, cutting out those unnecessary expenses or things you don't even use, and start looking at assets. That again is another thing. When you start building wealth, when you start reducing stress, when you start building your financial system, it is about what is adding value to my life and what is also going to add value to a future you. When you start thinking in the next 5 years, what is going to grow in an asset? When you think of a vehicle, depreciating asset. When you think of a home, kind of a toss up, usually an appreciating asset. But a lot of things that we purchase have a shelf life, meaning there's only going to be so many years you can use it. Then it's going to be getting rid of it and really starting over with something new. But of course, the very first step you can take today, start tracking your expenses and create that budget. As a financial counselor, there's never a point where I'm going to say the budget isn't worth it, regardless of what you want to call it, a spending plan, a budget, anything that you can utilize to really track your expenses is going to be a game changer. So thank you guys for watching the video. I'd love to know from you in the comments down below, how do you live within your means? Where do you cut the budget and what strategies have worked for you? Also, of course, don't forget to tune into all the videos that we're putting out on a daily basis. Subscribe to the channel. Let me know any budgeting tips that definitely work incredibly well, and I'll catch you guys in the next video. The S&P 500 has been absolutely fire this year, and a lot of the gains that we're seeing have not come from those really large tech companies, which is great to see. In today's video, I want to drive down and really drill down to what the S&P is going to look like for this fall, even going into Q4 of 2024. So let's go ahead and break into this. So looking at the beginning of 2024, majority of the indexes were having a very narrow range, meaning in that first quarter, it was tech, more tech, heavy tech, artificial intelligence. everybody was buying the exact same thing. But when you think of yesterday, which closed out quarter three with the end of September getting into October, let's see exactly how this has changed. Now, this is from an article on the State Street, and I definitely want to cover this because when it comes to the S&P 500, even looking in Warren Buffett's forecast, 90% of people should be invested in the S&P 500, which is kind of crazy. So when we think about this, for a year to date, tech is still the leader, but not really as much as people think. It is up 29.6%. When you're thinking of the S&P itself, it is up about 20%. Even looking at some of the biggest drivers like Nvidia, it seems like it soared very early with the promise of artificial intelligence and also those big semiconductors and sort of kind of leveled out. Now, when we think of the Federal Reserve doing that 50 basis points cut, made a big difference. And of course, that made a big difference in a lot of different places outside of tech when it comes to the growth factor. There are two things really to remember that are going on in the news today. Number one is the port strike. Now, they have said that 46% of all imports come through the ports, which are on the East Coast and also the Gulf, that are on strike. As of right now, we don't know exactly what that's going to look like, but that could affect some big businesses. And the threatening of really the broadening war of Middle East already been kind of warned if you checked out some sources that gasoline prices could absolutely skyrocket. But when we look at today, it was another record day, which is kind of crazy. But those tech stocks have kind of price to earning ratios have leveled up. Now, when we think of Nvidia alone, up 82% in the first quarter, but still up 145% this year, which again is kind of crazy. But when you think of the profits and the money this company is really bringing in, it's insane to think. The shares fell 1.7% thanks to part 5% in July. So we did see a little bit of pullback like we were saying with tech, but the S&P right now finished the quarter 20.8% up year to date. And it was the biggest gain through the third quarter of the year since 1997. So, I mean, we're going back almost 30 years with this big gain that we're seeing in the S&P 500. Now, when we start thinking third quarter and just thinking of our last 3 months, overall dominance was utility stocks. Again, I love to see this and I love the versatility. I love the risk mitigation of all the different sectors because utilities were rocking and rolling. Utility sectors was up 18.5% for the quarter, 6.4% in September alone. And of course, with that 50 basis points reduction with the Fed, real estate stocks rose 16.3%. So we are seeing a massive, massive push of utilities and of course the real estate. Then when you couple it with all of the tech growth that we've already seen, tech, a lot of people are saying are overbought. They're saying it's wildly overbought. The price to earnings ratio don't make a difference. But when you start looking at some of the top performers within the utility companies and really some of the energy companies, they are doing incredibly well. They even note in here utilities Vistra, which is VST, up 38.8% on the quarter. Constellation up 32%. Some of the top performers in September alone, kind of crazy. Now the laggards are the ones that are really pulling it down are the oil and gas producers. So there's a couple in here, including Dollar Tree was noted, that is really bringing it down. But when you start looking at some of the Home Depots, Caterpillar's up 10%, 9.8%. But looking at Boeing, of course, with those safety issues, down 12%, JP Morgan Chase down 6.2%. So a lot of up and downs. Now, of course, recession worries grow, then ease. So we're seeing a lot more in a little bit more of a step towards a possible recession. The economy was giving off noise that we could be looking at a recession in the future, but with so much money leaving tech stocks, and this is where it's kind of happening. And that is why we're not seeing again in Q2 and Q3, we are not seeing the massive buildup in the accumulation of tech stocks. Is a lot of money were pulled out of these overvalued tech stocks. They were moved into a bunch of other things with stocks with a lower P&E ratio, which again, when you look at tech stocks and the price and earning ratios, it goes kind of crazy. And investors look at a lot more favorable stocks, even thinking of things that are dividend paying. Even we have seen a big rise in a lot of the dividend paying stocks and the yield, more of the stability. The S&P tech sector was up 1.44% in the quarter, 2.54% in September. So of course, the quarterly performance was the third worst 11 of the 11 sectors. And of course, this is pulling money out of those big tech companies. Now, when we think of looking at really September and this third quarter, there are some of these sectors that are doing very well. Looking at utilities, again, for the quarter, up 18.46%. When you look at consumer discretionary spending, 7.6%. Communication services, 1.4%. So a little increase there. Real estate, again, 16.3%. Massive increase in the real estate sector. Even looking at some of the consumer staples, 8.2, financials, 10.2. Very interesting to see that financials for the quarter were up 10.2 when JP Morgan Chase, one of the biggest contributors, was down considerably. Healthcare, 5.6, energy, 3.12. So again, when you start looking at the quarter, it was not driven by tech. Tech was actually up 1.44, with the IT sector only a 1.44% growth. Again, thinking of what we see in the dominance in quarter one, definitely making some move within that S&P 500. So year to date, this is where we really tally it up. IT still running it, 29%. So if you are heavily invested in those tech ETFs, which I personally love to hold, you would be up roughly 30%. Now, when you look at communication services, 27.8. So literally right there, almost hand in hand with tech, again, leading to this big performance of the S&P. Utilities up 24.5%. This is also kind of the controversy that we've seen if you're in the political front, with a lot of the utility companies kind of overcharging consumers and really price gouging. I know that's a thing that a lot of people have said about when you're looking at like discretionary or staples, things of that. Even consumer staples up 16.5%, industrials 19%, consumer discretionary 13.21, and it just goes on and on. Healthcare 12.9, materials 12.5. We have real estate up 11.4, and energy up 5. So when you think of all of the sectors that we have within the S&P 500, they are up, and this is the reason why. You combine, information technology, communication, utilities, and financials. Those are all four sectors that are up 20% or greater on the year, which is just absolutely phenomenal to see. Now, of course, the S&P 500 doesn't always run like this. We don't see, an absolute banner year like this all the time. But for me personally, I do invest heavily into that S&P 500. Even thinking of my portfolio itself, my 401k portfolio, went through a bunch of different things, went through some tech stocks. But overall, because you're really pigeonholed into what you can invest in, I invest in the S&P 500 in the entirety of a 401k portfolio. I do not choose to do international. Now, when it comes to the international market, it is something personally that I do not invest in. I feel like there are so many companies within the United States that are large enough. They are global. They are in pretty much every major market in the world, even some of the emerging markets. A lot of the large companies, and even thinking of the US economy itself, it is roughly 50% of the global economy. So when you take that into account, investing in something like this S&P 500 does incredibly well. And I really feel like over the next 3 months, we're going to see the continued growth as in what is driving this S&P 500. And again, I feel like we're in a really good place, especially because it is not driven all in its entirety 100% driven by the tech stocks. It is driven by everything else that we do see. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think about this S&P 500. And as always, thank you guys for watching. As America, we can finally breathe a sigh of relief. The Federal Reserve has reduced the interest rates by 50 basis points, which is a significant cut, a lot higher than they thought they were going to do. This is the first cut that we've seen, or the reduction, since March of 2020, which we know was the introduction of COVID. So looking at the new target rate, it is 4.75 to 5%. But the problem is, what does this mean for an average American? What things in your life are going to get cheaper, and what things could stay the same or essentially get a little bit more expensive or a little hard to find? That's exactly what we're going to be looking at in this video. Now, of course, prior to Wednesday, it had been 11 consecutive rate increases over the last 10 years to try to tame inflation, which peaked at 9.1%, drove the prices sky high for pretty much everything. When you look at current inflation rate of 2.5, still below the Fed's target of 2, it is getting there, and the Federal Reserve is confident that it is going to do that. Now, the Federal Reserve, it is a dual mandate. There are two things that are controlled and really manipulated by the Federal Reserve. Number one, keeping inflation low. Number two, maximizing sustainable employment. That is right. So the upside risk to inflation has diminished, according to the Fed Reserve Chair Jerome Powell. And of course, the downside risk of unemployment has increased, which was the reason for the big decrease when it comes to the interest rates. Now, how much cheaper could it be? This is where it is going to impact you and impact you really big because, of course, when it comes to lenders, when it comes to financial institutions, just like I work at, it really determines the rate for everything. The Fed's fund rate or the prime rate is what is the driving cost because for businesses, it is really reducing the borrowing cost of money and it is the cost that is associated with money itself. Now, again, thinking of the first side of this, what is the impact that it is going to have on you with this in knowing the way that the stock market is going? Credit card rates are going to drop. With a 50 basis point reduction, most credit cards within the next few billing cycles will go ahead and bring these averages down. As it sits up today, credit card averages are 20.78, which is down just a little bit, but we're going to continue seeing this and really pulling it back, which means you're going to have a little bit more room in that budget with a few bucks off of the monthly interest. So even when you're putting more money towards the card, it is going to be paid off exponentially faster because, of course, the interest rate is going to be lower. So when you make your regular payment, a majority of it, or not all of it at this point, is going right towards interest. You're going to see less interest. Now, also with auto loans, that's, of course, when you think of saving a couple bucks here and there. If you're saving a little bit on credit cards, it is going to do the same with auto loans. So at this point, auto loan market has been a little bit more stagnant than they would like to see, meaning that cars are not moving as fast as they would. When you look at the average price of a car around $64K and you put it at about a 7% interest rate, you are talking about an $800 payment, which is incredible. When that rate starts coming down, that monthly payment or the monthly liability on that does come down slightly, which means, again, cutting a 0.5% might not be a game changer for a lot of people. But if you're buying a used car, if you're buying an average, let's say 20, 25,000, 0.5% can make a pretty big difference when it comes to that payment. Now, of course, home equity lines of credit. If you have a home equity line of credit, if you have an interest only, if you have anything that is tied to interest rates itself, you are going to see a reduction. So thinking of a $50,000 home equity, you would see a decrease of about $21 a month. Again, a lot of people think that the 50 basis points is going to be a game changer. It is going to fix all of the woes. It is going to fix all the problems. That unfortunately is not true. With the reduction in the basis points, everything systematically is going to get cheaper. So think about the credit card. Let's say you're saving $5 or $10 there. Auto loan that you just purchased or looking to purchase, you're saving 10 or 20 bucks there. Even looking at a HELOC, you're saving about 20, 25 bucks there. Systematically, everything is going to start kind of going downhill with the payments, with actually the interest that you're paying on there. And of course, if you do have an adjustable rate mortgage, the payments will drop slightly as well. Now, mortgages, of course, a little bit less directly tied to that Fed's fund rate, but overall, they will come down a little bit. Now, when you start thinking bigger picture, at this point, as the economy sits as of 2 days ago, we've seen very, very high rates with CDs. We've seen 5+% interest rates on CDs. They have already started pulling them back. If you look at most of the major financial institutions, looking at your Chase, your Bank of America, your Wells Fargo, most of the CD rates have systematically pulled back. Most of the high yield savings rates have systematically pulled back. And of course, this is completely by design. When they make money cheaper, the banks cannot offer as big or as high as rates than what we've seen because, of course, money is now cheaper. It is not the same that it is. Now, of course, with a lot of bonds, a lot of bills, that will do the exact same. When the rates start going down, they are going to be tied to it, meaning the rates are going to drop. So on one side, if you're a spender, if you have credit card debt, if you have any adjustable debt, you're going to start seeing those payments go down. And the unfortunate side or the flip side of this, not only seeing things get cheaper overall, is if you're a saver, if you're someone who is sitting on some high yield savings accounts, if you're sitting on CDs, chances are when those come due, you're not going to see those same rates available from financial institutions because rates, as Jerome Powell has said, are continuing to go down, maybe even another 0.25% this year. But even looking at 2025 after the election, we could see multiple rate reductions going into 2025 until the Fed ultimately gets to their target. So what does it mean big picture when you think of the United States? When you think of our economy in general, making money cheaper means it is cheaper for businesses to borrow. That could be hospitals that are doing renovations, that are buying equipment, that are updating things. It could be building new businesses. It could be startups. There are so many things that essentially become cheaper because the cost of borrowing money is lower, which is, again, the big reason why we do have the Federal Reserve and why they do adjust it. So what that means though, again, when I think of the investment side, when I think of my ETFs, when I think of everything you have in a 401k portfolio, looking at the S&P 500, it is up almost 20% on the year. This is going to further increase the stock market and increase the value of the stock market because all of the money we talked about in those high yield savings, in the savings, in those money markets, in those CDs, when they start maturing, and there are a lot of them are maturing right now since the rates are no longer there, a lot of that money that is maturing is going to be flowing right into the stock market. You're going to see a lot more in the crypto market, which was up considerably today, looking at Bitcoin, looking at Ethereum. And then, of course, in the stock market itself, it popped about 2% today, which is kind of crazy because, again, a lot more money is going to be flowing into the stock market instead of sitting into all of these accounts when it really is due. And again, credit unions, banks, a lot of things are not going to sit on a ton of money because it doesn't have the value of what they were looking for while they continue to lend. So lending is going to increase. We're going to see more auto loans. We're going to see more home equities. We're even going to see more mortgages that are being signed because rates are starting to actually give a little bit and getting a lot more out of it. So the question is, what does it mean to you? Have you seen anything go down in rates? Have you seen anything go down in price, saving a little bit of money here and there? Me personally, I use M1 Finance, and I do have a link right down below. M1 Finance announced that the high yield savings account went down to 0.5%. The margin borrowing went down 0.5%. So right across the board, we lost the 50 basis points on what we were getting on our savings, but we also lost the 50 basis points that we were getting in the margin if you're looking to borrow money. So it does kind of tumble and go kind of hand over hand when it comes to reducing these. So again, the question is, where have you seen it? Is there a point where you've seen something cheaper? Have you been notified? Are you starting to see a lot of the CD rates and the savings rates kind of drying up? And also, what is the lowest auto rate that you've seen? I know some dealerships are offering some pretty killer rates, including up to 0% interest, but I want to know in your neck of the woods where you're watching what you have seen. And guys, that's going to do it for today's video. Let me know in the comments what you guys think, and I'll catch you in the next video. Join me as I challenge myself investing $100,000 into the 3 best index funds that we have for retirement, and I'm going to show you exactly how it played out. Now, a couple years ago, we started investing on a regular basis, and the portfolio that we came up with years ago is the same one that we're using today that I recommend you do follow. It is kind of crazy, not financial advice, but it has worked incredibly well. And when we break down this portfolio, I'm going to show you. Now, when it comes to planning for retirement, when it comes to investing, making smart investment is crucial. It is really the number one game changer when you come and look at investments, especially looking at ETFs, because they have that super low cost ratio. Now, one of the most effective things to do is building wealth over time through investing in index funds, which is exactly what I did. Now, by investing in these ETFs or these exchange traded funds, it spreads the risk across the entire market like the S&P 500, which does incredibly well. Now, I do not buy bonds. I do not buy anything that is international, and that is by choice. When we start looking at the US market, it is about 50% of the global market. And when you start looking at the companies that are within that global market, when you think of Apple, Nvidia, Microsoft, Facebook, they are global companies in themselves, meaning they operate in a majority of countries around the world. And of course, the other challenge that we see, or the problem that we see, is a lot of people FOMO, or they have the fear of missing out. And we also see people who do not go in when they should and actually pull out of the investment portfolio when they shouldn't. So they'll start seeing a couple red days. All of a sudden, they're all in. They are selling everything. Then, of course, when those red days are coming, that is the time you need to be dollar cost averaging in. That is the time you need to be putting a lot more money into these investment accounts. And really, when the market comes back, and it always has, you're going to be up tenfold, which is exactly what you're going to be seeing when it comes to the portfolio. Now, for me, we started this 3 years ago with dollar cost averaging. So let's hop over, take a look at this portfolio, and we'll break it down. All right, guys, so here we are with the 3 ETF portfolio. As you can see, this is our debt-free journey, just like we have right back here. And of course, if you like the content that we're putting out, definitely subscribe to the channel. Let me know in the comments what you guys think about the portfolio we built and how it has been really doing. So looking at here, this is through M1 Finance. Now, of course, there is a link down below. I have used M1 Finance for a multitude of years. And if you notice right here, this portfolio was actually started September 6, 2021. So to date, it is about 3 years, just shy of 3 years at this point. And you can also notice net cash flow, 95,000. So in the last 3 years, we have ranged about 32, what is that, about 32, a little less than 32,000 that we have put in here every single year. This is through dollar cost averaging. Like I said, when we start looking at the investment portfolio every 2 weeks, we make contributions into this portfolio. If the market's green, we make our contributions. If the market is red, we make those exact same contributions. Now, you'll also notice right here, the money weighted return. That is right. We are up 78.98, almost 79% in this portfolio in the last 3 years. Now, the reason for this is if you think back to 2022, it was a very difficult year from the stock market. Tons of people cashed out, tons of people sold. Just like Warren Buffett has said, when there's blood in the streets, when it's red, it is time to buy. Everything that we bought in 2022 was, of course, discounted 10% off, 15%, 20%, 22% off. When it came to ETFs, they were on a big fire sale. Again, dollar cost averaging, putting money in there, regardless of what the market is doing, is what we're doing. And you can also see from the beginning where we started with nothing, all the way up through where we are sitting right now. Breaking out the last, or really the year to date. So we're looking at the last 9 months here. Year to date right now, we're almost at 18%. Now, when you think, again, the last 9 months, almost 10 months right here, we're up 18% in this portfolio. And then, of course, when you start looking at all of it, you can see out of the 95,000 we put in, the portfolio value is 121 right now, meaning we have a market gain of $26,000 in the last 3 years. Now, I know for a lot of people, that is real money. As when you start getting a portfolio and when you start hitting that 100,000 mark, that is the reason why Charlie Munger, that is the reason why Warren Buffett, that is the reason why most financial advisors say getting that first $100,000 invested is really the big part. Now, at this point, when you get into the 3 ETF portfolio, the snowball starts rolling. You start getting a lot more dividends, much larger dividends. Those dividends that you get are reinvested into this portfolio. So not only are you seeing the growth of the ETFs themselves, but you're also seeing the rebuy when it does come to the dividends, combined with dollar cost averaging that I'm still making contributions in here. Even looking here, dividends earned, we've earned $2,000. And again, for a lot of people, that's a pretty decent amount of money. Even though most of what you see in here, we do not have a really strong dividend presence in here. And I want to show you the exact reason why. So getting into the fund portfolio, breaking it down. So we start off with the QQQM. Now, as you can see, now we were not always invested into 3 ETFs. For a majority of this, we were invested into one and only one. That was the VOO. That was the Vanguard S&P 500, which is one of my absolutely favorite funds that we have within here. And even Warren Buffett have said, if you're looking to index invest, if you're looking at the S&P 500, putting it in there and just having one single ETF for a majority of people can work very well. Now, looking at this, and I want to show you kind of the year to date that we have right now. Want to make sure this is what we still kind of have turned on. So year to date, you can see the Vanguard, the S&P 500 is up over 20% year to date. That is a massive gain. Now, of course, looking back, it's very easy to see the gains. Doesn't really predict what could happen in the future markets, but overall, that Vanguard, that S&P 500 is doing incredibly well. Now, the QQQM is very heavy, and it is based on the NASDAQ 100 versus that S&P 500. Now, there are a lot of companies that do overlap, and the big thing with the NASDAQ, it is as focused on the tech. It takes out the financial industry. It takes out a couple different things that are not in that NASDAQ versus that S&P 500. So there is some overlap. In here, I am not worried about overlap. I've talked about it. I've seen a multitude of financial advisors not really too worried about the overlap, because then, of course, we have the SCHD. Now, this is the Charles Schwab, the U.S. Dividend Equity. A lot of people do the VYM or the SCHD. There's a lot of different variances that you can come up with the portfolio. And personally, this is the one that I use. This is the one that I've used now for those last 3 years, and I will use going forward into retirement. Looking at this, it's very interesting because when you think of the market going down, when you look at the QQQM heavy tech, you're going to see a much higher or a much lower dip when it does go down. Same with the VOO. You'll see not as steep as a dip, And then, of course, the SCHD, which is companies that are large dividend payers. It is some of the most stable companies within the United States. So even when we see volatility in the market, the SCHD will stay pretty regulated, won't go down as much, won't go up as high as much, but it stays pretty regular within the market. Now you'll notice, guys, that 20% in that VOO, we're at 18% with the QQQM. Then, of course, we're at 15% with the SCHD. So even the very heavy dividend paying SCHD that we see right here, still doing incredibly well. And you'll notice there's a bunch of news in here. There's a bunch of stuff. When we go into the details of the SCHD, you can see it is a 3.35 dividend yield. Now, since the Federal Reserve has went ahead and pulled back a little, that 50% or 50 basis points that they pulled back rates, dividend yields and CD rates are going to start going away. So not only seeing that we're getting a pretty good dividend yield in here, and again, the dividends are being reinvested into this portfolio, just like we do with everything else. This is one that I highly advise. If you're looking for income, if you're looking for passive income, this has given me $544. And I believe at this point, we've been in it for 2 quarters. It's been 2 or 3 quarters that we've been into the SCHD. But again, thinking of the portfolio and looking big picture, when we start really taking this back a step, if you look at the VOO, now the VOO is one that I have held the entire life of this portfolio. So in the last 3 years through dollar cost averaging, we are up 72.85%. That's right, guys, 72% in 3 years. Crazy to think of the growth. Since we have picked up the SCHD, we're up 21%. QQQM is up almost 24%. And again, thinking of the government and really lowering those rates. What happens when they lower the rates? Of course, when they pull them back, it is cheaper to do business. So the cost of money actually goes down with those 50 basis points that it was lowered. With money being lower, it's cheaper for larger businesses to borrow money if they're looking to invest. And of course, with the artificial intelligence boom that's going on right now, AI is really, really big, meaning next year, when the Fed continues to lower interest rates, money is going to get cheaper. A lot of these larger companies are going to go parabolic. They are going to go much, much higher due to the fact that money is going to be cheaper. A lot more people, a lot more startups can borrow money to get off the ground. A lot more companies can invest in themselves because money is cheaper when interest rates are lower, meaning this portfolio in the next probably 3 to 5 years, we will have doubled our money, maybe even by the end of next year, within 4 years, because of course, rule of 7, doubling your money every 7 years, we could possibly see this portfolio even faster than 7 years go ahead and double, and it does very well. Now, the last thing that I want to look at and I want to show you is you'll notice the weights. So the target weights in here, the QQQM is at 40%, this is at 30, and then of course the VOO is at 30. So what I did was earlier when we were looking at this portfolio, kind of based on age, QQQM being at a lot heavier tech, still have 20 plus years to retirement. So thinking of that, thinking of the retirement age of 65, putting a little bit more and putting those percentages into that QQQM makes sense because we have another 20 years of growth. But what we're doing systematically is every so many years, let's say every 5 years, I will change the variance in here. That way, when we're making more contributions, it's going to auto adjust. We do not rebalance this portfolio at all. It will auto adjust manually based on the pies, based on the percentage. For instance, if I take this 40 right here, and then I move the Charles Schwab to 35, I may move this one to 35, through contributions, it's gonna automatically catch up to itself when I'm going in there. You'll notice on the left-hand side right there, it does show that it's overweight. This one's a little overweight. And then of course, the bottom one is underweight, just based on the percentages. Contributions level this out in M1, which I wanted to understand and really show you guys how this does work. But this portfolio is doing incredibly well. And this is a portfolio where you can kind of set it and forget it. I'm not coming in here, I'm not checking it on a regular basis. We are letting this portfolio absolutely run as you see it today. In conclusion, investing in those index funds is a really smart play when it comes to retirement. Choosing the right funds like we've seen in that 3 ETF portfolio for long-term growth really increases your returns. I'm really making a very substantial nest egg in there. And then of course, starting early, being patient, investing on a regular basis is going to make a big difference. Thank you for tuning in, guys. Let me know in the comments, what is your favorite index fund, which exactly, and how are you investing? And of course, if you're new here again, subscribe to the channel. We got a lot more that's coming, and I'll catch you guys in the next video. Can you imagine a life where you didn't have to work every day? Instead of needing to work, you could choose to work and choose not to work if you wanted to. That's exactly what we're going to be looking at today. So in today's video, we're looking at 3 ways to make $50,000 a year as passive income without working. And this is a very interesting article from the College Investor. And it really talks, and I want to break this down because it's interesting to me, and the concept of really looking at it differently than what we're taught. So conventional wisdom tells us you go to college, you go to school, you get a good job, you get married, you take loans out for school, you take loans out for the wedding, you take them out for the car, for the furniture you're buying, for the vacations you're taking, for the house that you do have, work 30 plus years for all the debt that you've accumulated in your lifetime, paying it back, and hopefully maybe you will have enough money to retire. Now that is the American dream. That's what a lot of people are really being fed, but there is a different way to do this. And that is why I want to cover this article. Reading through it and reading through it again, it was interesting to see that not going the traditional route, and we are starting to see this with a lot of the younger generation. They're not going the traditional route. They are not running the regular 9-to-5 jobs. They're working remote. They're working flex jobs. When looking at Uber, looking at a bunch of different places, they are working and really creating a lifestyle that does not follow the traditional 9-to-5. Now, when we start thinking about passive income, it is not something that happens overnight. It is not like hitting the lotto, but it is really looking at utilizing your time for your money. That is the big thing. When you can get to the point of building enough passive income that you don't have to worry about the 9-to-5, you can work if you want to, you can do something that you love, and of course, having no debt. When we talk about debt mitigation, when you talk about making $50,000 a year, for a lot of people, that's a lot of money. For some people, that isn't any money at all if you're making $200,000-300,000 a year. But overall, when you think of your bills and paying and having $50,000 a year on a regular salary that is coming in passive income, that generation could be enough if you don't have any bills, if you don't have a mortgage, if you don't have a car payment, if you don't have, all of the regular bills that people do. We're talking about residual income that you're having on a regular basis. Now, they talk about front loading your life. Now, this is one of the absolute favorite hacks, and I like this as well. So, of course, this talks about younger years. So when you're starting out in your career, it is working much harder than an average person. It might be working that 9-to-5. It might be working 2 jobs. This could really build a snowball. When we think about the debt snowball and eliminating the debt snowball, this is doing it almost in reverse. This is taking your income, and let's say, for instance, you start your first job, you're living at home, you're not paying rent. All of your income you have from that first job is just income. You don't have many bills, you're not paying utilities, you might have a car payment, a lot of people don't, but overall, you can start off life, if you're starting it off in this nature, building a giant snowball, meaning taking 50, 60, 70% of your income at the age of 22, 23, 25, regardless of what it is, putting that into an investment account and letting it start snowballing the opposite way. So it's not you taking out all of these loans, spending an absorbent amount of time trying to pay them off with interest. It's building a snowball and getting to the point where you're starting to earn that passive income. And of course, when you look at investments, it's going to take a lot to get to that 50,000 per year that you're getting. But if you could do it and start this early, and by the time you're mid 40s, maybe 50, you could go ahead and have 50,000 plus of passive income every single year. And that is exactly what it breaks down. Now, there's a few ideas in here. They said working hard and really front loading what you're looking at saving could be anywhere between 10 to 30 years, depending on how much and how fast you're investing, how smart you are about the methodology behind investing, and of course, what you're looking to get out of passive income, depending on what your bills are. Because even thinking about this, if you and your partner, your spouse, your significant other, if you have multiple people that are doing this in the same place, you can accumulate a lot of wealth very, very quick. Now, the first one they touch on is own 10 rental properties. That nets you $420 per month each. Now, of course, when it comes to rental properties, that is a business I do not want to get into. But when you think of a lot of different places, it can come with a lot of, with a high price tag short of just getting that monthly income. But when you start looking at maintenance, repairs, property management, taxes, insurance, you're going to have to bring in 50,000 plus out of these 10 properties to really net that $420 each month to make sure that you have enough to bring that $50,000 every year. Now, of course, this is going to be super dependent on where you live, very, very dependent on your lifestyle, what you want to do. Me personally, real estate is something that has never interested me. I don't want to be a landlord. I don't want to worry about it, but depending where your goals are and depending, because again, in the scenario where you're working a 9 to 5 job, picking up these rental properties through the next couple years, having one, saving a bulk of the money to buy a second, a third, a fourth, faster and faster, it will snowball into more properties on on really a faster rate. Now, if you want to become a real estate investor, now this is more of my really big thing. So when you think of real estate, a lot of people say real estate will never go down. Real estate will always accumulate. Real estate will always make money. We know that was not true 2007, 2008, when the real estate market, really lost about 50+% of the asset that was there. It was kind of crazy. But when you start looking at crowdfunding, now personally, for crowdfunding, this is allowing a lot of investors to put their money together. And we have companies like Fundrise, which I'm familiar with. I've invested with Fundrise. Fundrise is a company that owns original online real estate platform, requires about $10 to get started. And with Fundrise, they crowdfund platforms and they crowdfund real estate investments. So most recently, they were building an entire community of houses. And with those houses that are built, they were site condos. Those site condos were rented. They were not houses that were built and sold. They were in really what Fundrise is doing is they are building a lot of site locations with different communities, different condos, different associations, and they are getting the revenue from the rent. So as people pay their rent, that rent is going back to all of the crowdfunding that people are doing in here. Now, it's making a really big return because guess what? Number one, everyone needs a place to live. And of course, they are making housing in some markets more affordable than the current market is, meaning they could charge a little bit more. And overall, looking at the returns that they're getting, it really, if you offer a little bit of a lower rent, you can fill up all of the units within there and make sure that you're getting rent versus charging a higher rent and having, 50, 60, 70% capacity filled. They are about having them all fully rented. There's a couple other ones they mentioned, roof stock, equity multiplier, farm together. There's a lot of in there, investing in farmland, commercial properties, real estate. Even if you're looking at stocks, I know which is a real estate that does incredibly well. That is a company that does a lot of investing, but Fundrise, again, is one that I've personally used. Now, looking at the third way they have in here, accruing 1.25 million worth of dividend stocks with the 4% yield. Now, the HD is almost at that 4%. This, of course, would give you, at first glance, very, very hard to get 1.25 million when you start looking at the rental properties. But honestly, when you're looking at the methodology with dividend investing and reinvesting until you get to the point of having enough cash flow. Now, this is where it really triggered me on how easy this is and how you can actually do this. So for me personally, I am doing investments every 2 weeks. I am doing dollar cost averaging into the SCHD. I'm putting some into the QQQM. We're also investing in the VOO. So I have that 3 ETF investment portfolio that is growing. The SCHD is generating dividend income that is being reinvested at this point. So what I'm doing is with those contributions every 2 weeks, we're putting a lot into ETFs. We're putting a lot into the stock market. And what I'm continually doing is increasing my stake in the SCHD as we continue to make contributions. And the SCHD, in turn, with me holding more of the ETF, is paying me back a higher dividend over and over and over again. Now, at this point of my life, I'm still working my 9 to 5. Very happy. I love what I do as a financial counselor and an educator for individuals. And overall, loving the YouTube experience. And if you like it with me, definitely subscribe to the channel. But we're starting to see the snowball and the compounding interest. For this quarter alone, with those 3 ETFs, which we have invested, we yielded about $1,000, which means just off that investment, we're making $4,000+ a year between the dividends that those 3 ETFs are paying. And of course, when we're putting all of our contributions, this year it's $1,000. Next year, it could be $1,500, $2,000, so on and so forth. But as we're putting more into that SCHD, because I'm upping the percentage that's in there, we are getting a much higher return, and we are continuing to snowball this just like we talked about in this article. Now, when it comes to dividend stocks, I do not advise doing the stocks. I advise doing the ETFs like the SCHD, which again is going to have that 3-to-1 split October 11th. So it's coming up pretty soon because they are not only increasing the dividends that are coming from that, they're also increasing the value. And we are seeing a big appreciation in value with the portfolio that they have, reinvesting to the point of me hitting retirement. Then I can go ahead and I can flip that switch. We have a good 1.25 million invested in the SCHD. I can get $50,000 just out of that investment itself, coming back to me every single year in the dividends that they're giving me, which right now is like 3.63. So it's almost 4%. So even if it's a little higher or lower, I am okay with it because that is going to be my supplement to Social Security. When we think of Social Security income, we know it's pretty limited, but if I'm getting, 2,000 plus a month from Social Security, and then we're getting some out of there. And then we also do have, our 401ks, we have our Roth IRAs, we have our HSAs, we have a lot of things in place to really go in there and really make it well worth it to get the investment. Now, of course, for me personally, M1 Finance is the only place I have the high yield savings accounts. I also have all of my investment portfolios if you've checked out my video. So if you want to check out any of those, I do have links down below so you can go ahead and check them out. So again, a very interesting article right here that we did see from the College Investor, 3 ways to make $50,000 per year without working and getting it through the passive income. I know a lot of people like the real estate. Me personally, again, I would not own real estate. I would do the real estate investing and I do the dividend investing as well to create that passive income. And it's getting to the point we're getting ready for retirement. 50,000 in passive income is going to be a realization, which again is very cool to see. So guys, that's going to do it for today's video. Let me know what you guys think about these 3 ways. And as always, thank you guys for watching. When there's uncertainty in the market, investors turn to dividend paying companies as a reliable strategy to generate that passive income and of course, enhance the portfolio. And in today's video, I am going to be talking about my favorite ETF, which is the Schwab US Dividend Equity ETF, or the SCHD. Now, this is a tried and true, delivering very strong returns, even outperforming those S&P 500 funds for the last 5 years with a very executable and strong growth strategy, well-rounded, very well-built income-based portfolio, which is the reason why personally I do carry it in my 3 ETF portfolio in a very big majority. Breaking this down, it is incredible to see what is coming with the stock split, which is coming on October 11th. But looking at the SCHD, now why is this such a big ETF? It really contains 2 things. One, quality of the companies that are invested in here. The second one, the growth of the companies that are invested in here as well. When you start thinking of long-term capital appreciation, the Dividend Exchange Traded Fund, this ETF specifically tracks the Dow Jones US Dividend 100, which includes 100 US-based companies that have a proven dividend profile, very strong fundamentals, and very strong balance sheets. That is something that really goes above and beyond with the SCHD, beyond just the dividend paying history in those companies. They are looking and breaking down the companies for financial health, not just the dividend payout. This includes strong balance sheets, dividend payout ratios, and a potential for earnings and dividends in the future. For example, when it comes to the SCHD, one of the big things they consider is the debt to equity ratio, the D&E ratio, which of course indicates the less resilience on borrowed funds, meaning that when rates do go up, money is a lot more expensive. As we've started to see a little bit of the depreciation with the Fed fund rates or the reduction, it makes money cheaper. It gives companies the ability to borrow. Now, when we start thinking of the ROE or the return on equity, this again is another thing that is a very positive signal for companies, meaning that dividends aren't going to be cut, the company's not going to go under, and of course, looking and minimizing risk. They do not want to cut dividends in the future because that could affect exactly what we're looking for in this ETF, which is that dividend growth. Now, when you look at the SCHD, also the diversification is across a lot of different sectors. It's not reliant on tech like we see with the S&P 500 or even the big growth like the VUG. It really looks at US large cap companies across all the diversification of different sectors and looking at that risk mitigation and companies that have paid dividends for an extended amount of time. Now, when we start breaking down the numbers, the historical performance, which of course is not indicative to what's coming in the future, but when you think of this ETF's legacy and how it is really performing, it is kind of crazy. So it's delivered an impressive 13.4% since inception, which is incredible, surpassing the S&P 500, which is roughly about 11%. So doing a little bit better, but also the track fund. And really during that time, they're using a well-executed investment strategy, emphasizing a dividend income and capital appreciation. This, of course, is where institutions have really started buying into the SCHD. Current dividend yield just north of 3%. So even thinking of inflation and the growth that we have in there, S&P 500 is about 1.3 when it comes to the dividend. So SCHD, of course, when it comes to dividend payout, is going to pay out considerably more. Very high position with a very low cost ratio of a 0.06. So a little bit higher than we see with that VOO, but only paying out a lot more. So when you think of the momentum of this ETF as well, new 52-week high, institutions started buying it, driving up the price, knowing that there is going to be that 3-to-1 split that we talked about on October 11th. This is going to make it more accessible to a broader range of investors, meaning more money could be flowing into this. And of course, they're expecting enhanced liquidity, so they're going to be able to move more units, making buying and selling shares easier, and of course, contributing to the increase in price in the future. Now, very interesting, when you start looking at the SCHD, you look at, the VYM, you look at a lot of the competitors. When it comes to an investment strategy, it really stands out in a crowd with dividend ETFs, which we know are all over, because many dividend yields either really chase the high dividend yield or they focus on undervalued companies, where the SCHD takes a very balanced approach with both the dividend yields and the value of the companies themselves, which a lot of people are almost saying that it's falling out of almost like a dividend paying ETF and into more of a growth and a value ETF. So it has a pretty unique blend and a combination of things in there that make it very, very important as a building block. Like I said earlier, 3 ETF portfolio, I have the VOO, which of course is that S&P 500, going to be a little bit kind of appreciated and a little bit segregated into all of the different sectors of the market. We're going to have it invested in everything. That is going to be the core ETF. When we start looking at the SCHD, this is going to be the dividend. This is not only going to be the dividend, as we can see right here, but there's also going to be a really big part of the growth aspect that we're seeing with this ETF itself. And the last one, of course, I do carry is the VUG, which is the growth aspect within the stock market. So it is a lot more heavily vested into that technology sector, meaning a lot more growth out of there when the tech is doing well. Now, the big things to remember with the VOO, it really has a big part in tech. So if tech is up, the VOO is doing incredibly well. If tech does pull back, if we do see a little bit of a pullback from the tech sector, the VOO and the VUG are going to be a lot more impacted when it comes to the impact of those tech sectors and the pullback. When we look at the SCHD with the passive income, the generation, the very well valued companies, the pullback is not there as much in the SCHD. You also do get the dividend return, but it is more appropriate into a lot of financial companies. I know Home Depot is one of the biggest holders that they do have. There are a lot of companies that do make up the SCHD that are the basics, that are the very strong stability companies within the United States, which makes a really, really big difference. So is it worth investing into it? My opinion, a lot of people are saying wait to buy it after it splits. My opinion, guys, go ahead and get into, and I think they set a deadline of, I think it was actually a couple weeks ago to go in, but do you buy it before the split? Do you buy it the night of? Because I know it said October 10th, they were going to do the split, and then the 11th, when the market opens, the split is going to be in there. So when you start comparing this to a lot of different ETFs, it is outperforming an incredible amount of ETFs, has a very solid strategy, has an impressive track record, low cost potential for income and growth, which makes it very, very strong for an investment vehicle. Actually, very simply put, if you put into 3 ETFs, that's all you have to do. Consistent contributions into an ETF that is broken into 3 ETFs in that portfolio can really make a big difference. Potentially higher returns with the split that is coming. And Schwab actually did this with a lot of different ETFs that they split a ton of them. Now, of course, do your own research. I always say this in all my videos. Before you start investing, know exactly what you're investing in. If you open an account up, which I have a link down below with M1 Finance, or anyone else through Robinhood, putting money into something like the SCHD is not always guaranteed, but it is a very strong bet in the right direction. And when you start looking at investing in the time frame, we're looking at 5+ years of investing. So again, when it comes to building wealth, when it comes to generation, it is consistently investing over an extended amount of time is going to generate wealth. And of course, with something like the SCHD, it does have the compounding the compounding factor of the income that is being generated from this ETF. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think about the SCHD. And as always, thank you guys for watching. What if you could fund a retirement plan on just $1 a day? The problem is a majority of Americans do not set aside anything when it comes to retirement. When it comes to retirement planning, a lot of people miss the boat. But when it comes to $1 a day, it is really looking at the long run, starting at an early age and really being impressed with the sizable returns that you can get on the $1. This is not going to make you a millionaire by any means, but you can set aside a chunk of money for the retirement fund. In today's video, we're going to be looking at two different accounts. One is our high yield savings account, and the second one is the S&P 500, which is my absolute favorite ETF to go ahead and invest in. So starting with our first one, high yield savings account. This is the easiest way to save that $1. You can automate it. You can move $1 from a checking account to a high yield savings account on a daily basis, completely automated. That means in the course of a year, you're not going to miss any contributions. You're not going to be short. That $1 is always going to move over. Now, when you start thinking of this in comparison to your traditional financial institutions, looking at the brick and mortar banks, according to the Fed, the average interest rate in savings accounts was a 0.46 as of September of 2024. When you think of inflation, the banks and the brick and mortar bank accounts are paying you less than 0.5% to keep your money there. With the recent cuts that we've seen from the Fed, some of those are paying even less, which is kind of incredible to think that they are giving you nothing to keep your money in there. And that is why the high yield savings accounts do make a big difference. Now, down below, I have a link for M1 Finance. That is where I do keep all of the money in my high yield savings account. That is also where I do my investment in the VOO if you're interested in signing up for that. So looking at to invest $1 a day with that 5% from M1, over 1 year, you're putting $365 in there. It will grow in the course of the year to $374. So you're making a little bit of money, not really game changing. But when you think of the same investment at a brick and mortar place, looking at a financial institution, you'd have made 84 cents instead of about $10. That's a pretty big difference. Now, when you start looking at a bigger time frame, so thinking of your 10-year, at this point, you'd put in $3,650. That would have grown into $4,700 just for the rounding. Now, when you think of 40 years, again, stretching it out at a much, much bigger pace, that 40 years would give you $14,600 invested. That would grow into $46,000 at $1 a day. $1 a day over 40 years, you can see out of the $14,000 invested, you're doing $46,000. With the traditional, you'd have about $16K or have about a $30,000 shortfall if you put it into traditional brick and mortar versus having it in that high yield account. That is a $30,000 shortfall that you see with that exact same investment. Now, this is where it gets interesting. Getting into the stock market. So thinking of the S&P 500, where if you're getting a 5% return in that high yield savings, the S&P 500 yields about a 10% return. When you start looking at this, and the big difference between these is high yield savings accounts, this is going to be short-term money. When you're saving in there, it is going to be your emergency fund. It is going to be something that you have to keep liquid that you know you're going to have in probably the next 2 to 3 years that you're going to be using. Now, when you think of wealth generation and building long-term wealth, this is where it gets building over a course of a lifetime. When we look at that 40-year time frame, stock market is the only place that you should be investing. Sort of, starting your own business, doing real estate. The stock market has created millionaires and will continue to create millionaires. It is the biggest wealth generation tool that we have in the world, is investing in the stock market. Now, when you start thinking of the S&P 500 specifically, I invest in the Vanguard VOO, the S&P 500 index. It has never lost money in any 20-year rolling average and has seen about a 10% return. So in comparison to that high yield savings account, you're getting a double-digit return, that 10%, or doubling up the return that you're getting on that high yield savings. Now, the interesting point is when you get to 40 years, thinking of in comparison, so the 40 years was about 46,000 if you're going for your traditional high yield savings account. Looking in this account with the effects of compounding interest, investing that exact same 14,600 over that 40-year time frame gives you $196,000 by just investing the extended amount of time, $1 every single day. Now, breaking this down, looking at $196,000, that is more than we see in an average of people who are in their 30s, 40s, 50s, 60s, even retirement age, even 70s during retirement, have for an average balance in the United States, 196K just on $1 a day. And of course, $1 a day, not going to be a game changer for a majority of us if you set aside that money. Now, how can you build this even more? So you don't want just to be sitting on that 200K. Let's say you're looking at $1 million. You want to grow this up to $1 million, taking that 196K. And of course, most people can be very happy with this because you're well above the average that we're seeing in the United States. But of course, this is only $1 a day, 30 days a month. So of course, $30 a month. Now, if you look at that same 40-year window, instead of reaching and doing $1 a day, if you put it to $159 a month, so literally kind of 5xing what you're putting in there. So when you start breaking in this and breaking the 40-year window, that's just a bit over $1,900 a year. So even thinking little over $5 a day. So instead of putting $1, you're putting just north of $5 a day. That will give you just north of $1 million in 40 years. So again, $1 a day really does add up. When you start looking at $5 a day over that same 40-year window, you're looking for north of $1 million. That is based on the 10% average return of that S&P 500. And even if you keep it in the high yield savings account, you're still going to be really kind of crazy, because when you look at a comparison of those 40 years in a high yield savings account, you need to set aside $655 a month using the same equation with the compounding interest for the 40 years to reach that same $1 million, which again is kind of crazy when the investing option is $159 per month. When you start looking at the high yield savings account, $655 per month just to reach that exact same point of the $1 million towards retirement. It is an absolute game changer when you start thinking of the multiplication factor compounded over that 40-year time frame. Now, of course, when it comes to investing, when you look at that S&P 500 versus putting your money in that high yield savings account, investing carries a risk. There's no guaranteed for returns. There's nothing to say that the S&P 500 is going to, increase and actually provide that return in the future. But when you start looking and any rare year, when you start looking and really panning out to a 5-year, 10-year, 20-year, 10% is the average that we're seeing. Now, of course, when you look at the high yield savings account, they're protected by the FDIC. They do have insurance in there that is going to, but of course it can fluctuate. The rates can fluctuate. This is all just kind of hypothetical thinking of what you're putting in there. Now, for a majority of people, and again, thinking of that 40-year window, if you're putting $159 a month, break it down to a paycheck. So when you think of that $159, let's say you're even putting $79, I would say around $79 per paycheck. That is pretty low when it comes to retirement. Even then, if you think about like a 4 to 6% match, where if you're putting in $50, let's say they're matching that $50 you're putting in there, that gives you $200 a paycheck. That is investing $400 a month. Guys, you're going to have $1 million very, very quick. When you think again of the 40-year time frame, you're going to be essentially cutting that time frame a lot lower to hit that $1 million mark that we're looking for. And again, the higher and the better that you can invest, when you start getting to the point of eliminating debt, it is going to give you the power to invest. But even if you're looking at one single dollar a day, you can still almost reach that $1 million status. You would just have to invest in a little bit of a longer time frame. But when we get up to that $5 a day, you can be a millionaire in that 40-year window just putting money into the S&P 500. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think about investing $1 a day and investing that $5 a day to make that $1 million mark over that 40-year period. And I'll catch you in the next video.